Hi guys, and welcome back to the second of our Fund Managers Roundtable. We'd like to welcome to the table now. We have three very well experienced and super interesting managers I'm looking forward to chatting with today. We have Henrik Andersson from COO of Apollo Capital, Richard Galvin, co-founder and CEO at Digital Asset Capital Management, and Marco Lim, managing partner and CSO with MaiCapital. Welcome and thank you, gentlemen, for joining us.
Thanks for having us, Matt.
Thanks.
Thank you, Matt.
Look, to start today, and you know, I think the first panel showcased this. It's great that the audience are participating, so please do add in your questions on the chat on the right-hand side. And just a reminder, at the end of this panel, we'll be moving to the virtual lunch where all of the managers will be available and sitting at their table to continue on with the dialogue. But I'll remind you of that at the end of this 35 minutes. Perhaps to kick it off, let's start with each of you sharing your background on your view prior to joining the digital asset space. Also, what you guys are doing now at your respective firms, and a bit about why you're doing it. So, Henrik, if you want to start us, please.
Sure. So, my background is in traditional finance. I spent around 15 years in quant equities and institutional equities across Scandinavia, where I'm originally from, Singapore, and I spent 10 years in New York. So split between the buy side and sell side. And I've been in the crypto space for the past 8 years. I run a firm called Apollo Capital, based out of Australia. So we run two strategies. One is a multi-strategy crypto asset fund that has over a three years track record now. It's an award-winning fund. And we also run a second strategy, which is a market neutral sort of pure alpha fund, which is a much newer fund that we spun out from the multi-strategy fund last year. So that's what we do. We are across the whole space, from early seed investing to kind of secondary markets, but we kind of focus on crypto assets only.
Yep. It's Marco here. I'm from MaiCapital. Our firm is a licensed SFC asset manager firm with Type 4 and Type 9 license. We manage crypto. Beside crypto assets, we have blockchain related listed company as well, some equities, and also crypto related derivatives trading as well. So we run two funds. Our first fund is a flagship fund, which is a long short crypto strategies with trading the most liquid top 10 crypto and a mix of their derivatives as well. That fund has been running for 2 years, great track record. And our second fund just launched it last year. We're purely just trying to track Bitcoin and outperform Bitcoin, and have been doing well as well. So it's underweighting and overweighting on Bitcoin and trying to, momentumly track it. My background is also from traditional finance. I've been working with sell side, building electronic FX and commodities trading business for Deutsche Bank, Credit Suisse, and my last role with Goldman Sachs, building their electronic FX and commodity distribution network. And it's very similar, to crypto as FX as 24 hours trading. And I got the chance to meet my two other partners, where I joined them in 2019, and we launched that fund in first quarter of March 2019. So that's my background.
Thanks, Marco. My name's Richard Galvin. I'm the co-founder and CEO of Digital Asset Capital Management. I'm based out of Sydney, but our firm's global and our investors are largely outside of Australia, so we've got a global investor base. Prior to starting this firm in 2017, I was an investment banker for 20 years, had around 14 years at Goldman and about 6 years at JP Morgan, all on the M&A advisory and financing side. The two key roles I had was I was the co-head of the TMT, or Telco Media and Technology Advisory Group for Goldman down here. and then moved across to financing and ended up running JP Morgan's equity capital and derivatives markets team. But again, all focused around TMT, high growth tech, media, technology, transformation type companies. Left bank in 2016, started setting up this business early 2017. We started running our first money Q3 2017. We now run 3 funds. We run a venture fund, which has been ranked by Crypto Fund Research as a top performing fund in 2019, 2020. We run a long only fund, which again was the second best performing fund by Crypto Fund Research in 2019 and won its category in 2020. And we started late 2019 market neutral fund, which is basically an income market neutral generating fund.
Great, thank you, gentlemen. Look, one of the reasons I was excited to speak with you all today was you've certainly been early movers in this space and have all come from very impressive traditional backgrounds. And perhaps we can start today by maybe just taking a bit of a step back. I was reading some commentary recently that likened the crypto space at the moment to the early days of hedge funds, perhaps when they can deliver on their original promise, which was really the maximize absolute and risk-adjusted returns in a relatively uncorrelated fashion. And when you think about the similarities of return and risk profiles, there are some similarities between the crypto space and the early days of hedge funds, but many differences in terms of a traditional hedge fund manager and a digital asset manager. Now, for our audience who are predominantly new in this space or looking to be educated, what do you look at in terms of, for them, a digital asset manager and helping them in terms of trying to assess a new manager as they're looking to make an investment into digital assets?
Yeah, look, I think you're right. So in many ways, we're still kind of early days in the crypto fund management space. It's a fairly inefficient space, I would say, overall. So there is a lot of alpha to be had for professional managers in the crypto space. I think that will probably remain the case for some time still, because kind of the traditional managers entering the space, they will most likely continue to focus on Bitcoin, but the space is much larger than that. So I think, if you want exposure to the space, I think active management makes a lot of sense because of those inefficiencies, because of that alpha opportunity. So I would look for an active manager in the space. I think that thesis has been played out, certainly when you look at our returns for the past 3 years, comparing that to any passive strategy. I think the active strategy outperforms over some time in the crypto space. Other than that, I will look for teams with a background both from the traditional space. That's still important, that kind of discipline. But I will also look for that combination with some crypto experience, because we see new managers entering the space. In the crypto space, it's quite different from the traditional space in many ways. We're not investing in stocks or equities. We're investing in software protocols, right? So in some sense, it's a completely new area of investment, and you need that experience as well. So I would look for that combination of traditional and crypto experience, and I would look for someone who's active in the space versus passive.
Yeah, I think Henrik's made some great points. I think the thing I would add is there's so much happening. This is probably the fastest moving tech environment in the world, I think, by some magnitude at this point in time. So there's so many things happening. There's so many developments. There's so many adjacencies springing from what is the most disruptive technology we've seen probably in a generation. So I think it is important that a manager has some form of thesis and thematic and some form of focus. You can get distracted and pulled in a lot of different ways if you try to cover everything that's happening in this technology. So I think it's important that a manager has a clear sort of view on where they think value will accrue through this asset class, where they're going to focus their efforts, because we're fortunate enough now with the growth of the assets that there is enough choice, there is enough alpha to be found, even if you take somewhat of a concentrated view on where you're going to play within the subsectors of blockchain tech. So we think it's important that and that's what we do, try to have a succinct thesis about how we'll invest and where we'll focus our capital on, where we think value will accrue for our investors.
Yeah, thanks, Richard and Henrik. I agree with you guys. I think this is a space that with a lot of alphas and active manager definitely stand out from here. And I think Henrik mentioned a few things. Track record, the team. You have to both have traditional experience in managing traditional asset and also crypto experience as well. And I think track record is one thing that's really important, and that's why we started the fund early and try to run through different market scenario, including the March scenario as well. For last year, with the volatility in one-day drawdown is huge. License is another thing. I think maybe work with someone with license as well. I think one thing that many might not have mentioned is the actually looking at the custodian, the operational risk of the actual managers. I think beside the return, how they manage market risk, I think something is to really look at how they do custodian risk and how they address counterparty risk, whether they're trading with licensed counterparty or not. Those are some of the things that I think when institutional investor were to access it, they should look at beside the return, they should look at how they address the whole operations and counterparty risk as well.
Perhaps just to carry on from that, we spoke about on the last panel about the 24/7 nature of crypto and the risk and risk mitigation that come with that. But Marco, to your point with risk and counterparty risk and operational risk and also risk regarding the uniqueness of the market structure, how does your firm look to try and manage that risk from an operational and counterparty standpoint?
I think one of the things is, for the operational risk, we do look at, how we handle the crypto, and also it's easier for a traditional asset manager just to, with a prime pool gauge, because it's already set up. Most of the fund admin very familiar with how it is, right? There's no really operational risk for trading, traditional asset because, equity won't be leaving the exchange. But when you're dealing with crypto, there's self-custodian, third-party custodian, right? Whether you pick, self-custodian, third-party custodian, that's really make a big difference to the asset manager as well. I think, for most of the regulated asset manager or somewhat, they do not do self-custodian. They rely on third-party to actually handle the custodian of the crypto. So that's one of the things that, when institutional investors look at it, whether, the manager use a third-party custodian, which is fully insured. I think that's one of the things that we look at for the counterparty as well that we are facing, whether they are custodian or their hot wallet are being insured. So that's one of the things that we look at for operational risk and minimizing counterparty risk as well.
I think that's one of the it's probably the least glamorous and probably gets the less coverage across this space, but it's probably one of the most welcome developments as a manager of crypto assets is the advancement in the technology and the robustness of the service providers we can work with now. I think over the last 18 months, that's come ahead in like leaps and bounds. To Marco's point, now that there is highly sophisticated, strong counterparties with insurance, which wasn't the case when we started to work back in this space back in 2017. So we think that's a great development. It provides more security for our investors. It takes the stress away from our team, so we can focus on what we want to focus on, which is finding outperforming assets, and allows us to have much more security, much more robustness about how we manage our assets. So it really is something that probably hasn't got as much press as it should, but the infrastructure here is moving almost as fast as the technology itself.
Yeah, I would just agree with what Richard and Marco said there. The infrastructure had come a long way in the past 3 years. So 3 years ago, it wasn't really possible to have a third-party custody or multi-asset crypto portfolio. But today, that's a reality, right? So it's been developing really fast, and which is really good for the whole space.
We speak about some of the opportunities within the marketplace due to the immature nature of the crypto markets and the inefficiencies that are present. I want to kind of fast forward as managers are looking at investing into the space. They'll have a 3 to 5 year horizon, and the environment in those 3 to 5 years expected will change dramatically, and some of these efficiencies will start to diminish, and some of the market structure opportunities will start to diminish. I'm just curious longer term players in here, how are you thinking about trying to adapt to that change, to adapt to those removal of inefficiencies and potential alpha opportunities, and then adjust your strategies or your firm's ideology to this market evolving? Richard, perhaps you want to start this one.
Sure. I think we look at the technology, and that's why we got so excited about launching the firm. We think we've got multi-decade tailwinds behind the whole asset class, and we do think this is a new burgeoning asset class and probably the most exciting technology opportunity globally. So we think just with the multi-decade tailwinds of digitization of the world, decentralization of society, and rightly or wrongly the falling levels of trust in traditional institutions, we think there's at least a 10 to 20 year tailwind of this technology being at the forefront of those generational changes. So we think we've got a long-term playing field in which to effectively find technology that's the most disruptive technology since the internet, where we will be able to make outsized returns versus almost any other asset class. And we put an overlay on that, thinking, well, just like the internet, we think blockchain tech will reshape many vast areas of how the world is run. But we put an overlay like you would on the internet, and see, well, where's it going to be monetizable, and where's that first disruption going to be focused? And that's where we focus our activities, which is around the financial services space, which we think is the obvious sort of first key use case for this technology. It's probably the second or third biggest sector in almost any economy in the world, and it's also a monetizable use case if you can get it right. So we think we've got at least 10 to 20 years of this tech moving through the economies and creating its own economies. First cab off the rank, so to speak, is around financial services, but we think there'll be many other industry disruption opportunities as we head down that timeline.
Yeah, I tend to agree with Richard there. I've been in crypto myself for the past 8 years. I've always seen a lot of inefficiencies in the crypto markets. They have been moving around, right? So, some time ago, there was pure price arbitrage between exchanges that could be fairly large. And then it's moving to other parts of the market, right? From basis trading to yield farming to other things, right? So the inefficiencies remain, but the space is evolving all the time. So it's just about staying on top of the involvement of the ecosystem. I don't see the inefficiencies in the market on the short-term horizon at all. So I agree with Richard that this is a very long-term trend. And as I said before, I think the new people entering the market from the traditional way, they will focus on Bitcoin and perhaps Ethereum at some point.
Yeah, I will agree with Henrik and what Richard said as well. So for our fund, for instance, we look for, beside now Bitcoin and ETH, we look for the, what is the next best thing that we want to be in, right? DeFi, NFT. So I think we continue to develop new strategies. I think that's the way to move forward to, instead of just stick with, as Henrik said, the exchange arbitrage, now going forward, there's a forward basis arbitrage, the carry basis as well. Will that market evolve into, different strategies? I think right now the market is still very limited compared to traditional finance asset class, but I think that will develop, allow asset manager to actually have different trading strategy within their funds.
Interesting. Yeah, and look, I'd like to just change topics here and pivot a bit more into fundraising and just get your views on how you found that. How has this process been, I guess? Has it been difficult, more time consuming, I guess, versus traditional asset management? And what things help you with your fundraising? And I guess how have conversation evolved over the last year?
Yeah, look, there's a lot less skepticism against crypto, than just 6 or 12 months ago. We have seen the announcements from the likes of Tesla and MicroStrategy, and we have seen some major macro investors entering the space. So I think that makes it much easier to have the conversations with the institutional investors, the family offices, and so on. So we see bigger players entering the space. The conversations becomes much more meaningful, moving on from just Bitcoin. I think most people have their head around Bitcoin these days. but the space is so much bigger than just Bitcoin. But I think having those kind of announcements we have seen in the space the last 6 months is helping a lot in those conversations.
Yeah, for us, the main difference, I think, when we started the fund in 2019 to 2020, and now this year, now there's a lot of licensed distributor that we have signed up to help, distribute our fund and fundraising as well. Where I think back in 2019 days or earlier, there wasn't, any licensed distributor or any broker dealers willing to help. I think there's some breakthroughs in they're helping, they're being educated. With now this crypto asset card become more mainstream, these distributor, which Hong Kong has, over 1,000 broker dealers, will come into play and help, educate the end clients on this new asset class, and which will help bring, new money into this space. And I think continuing, often have been signing up more licensed distributor, whether onshore or offshore. So that would definitely help on the fundraising for institutional as well.
Matt, I think that the two key things that have changed, I think, since the 4 years or so we started to talk to investors about the space is, consensus has shifted from, this asset class may not be around in a few years' time to, it's not going anywhere, and so it's here to stay. So you've got a mindset change with a lot of investors where they've now got more comfort that they can invest the time and the institutional cost or time that it takes to learn about a new asset class, knowing that there'll be something to invest in when they finish that process. I think the second thing we've seen change, which has been a dramatic shift in the dialogue we've had, is from our perspective, this digital assets have gone from a concept type phase to an adoption type phase. So we've gone from discussions where we've spoken about where this back in 2017, 2018, where we thought this technology could go, how we thought it would be adopted, and how we thought it would be monetized, to a discussion today where we can actually talk about examples of where that's actually happened. And that's obviously a lot more powerful discussion to have with an investor, where you can point to platforms or projects you've invested in which have grown user numbers, which have grown revenues, and which have delivered returns to you like you would expect from any risk investment that has succeeded. Those returns have actually matched fundamental growth on the underlying platform. That's something I guess we were only speculating about and we were painting theses about back in 2017 and 18, and that's obviously a much harder discussion and a much smaller audience that's willing to take that kind of risk. But clearly now with the examples, things like Uniswap and other examples of platforms earning substantial, multi-$100 million type revenue profiles, it's a much broader dialogue with a much more fundamental base of investors.
Just pivoting now into volatility, each of you run essentially a multi-strat ideology across your long books, your venture books, and some more directional fundamental stuff along with market neutral. You've obviously got different strategies there, and the volatility is such a hot topic it's always going to remain in crypto, where you can see 300% swings and then drawdowns of up to 75%, which naturally are going to mean that institutional investors are going to shy away. Within those strategies and probably broadly, how do you guys think about volatility, and then how do you think about that for your investor base?
Yeah, I think you're right, Matt. The volatility is going to remain in the crypto space for some time still, right? So what we're trying to do is we're taking advantage of that volatility. I think if you have strong convictions in the space and you can stomach the volatility, you can really take advantage of that volatility over a cycle. But I think it's true that it's going to remain there for some time. And I think that's also, coupled to the upside in crypto and the potential returns, right? So if the crypto markets becomes more mature, which it will over the coming years, that volatility will probably decline at some point. We will have ETFs, we will have other exchange-traded products that will help reduce the volatility. But when the market is more mature as well, you will not have the same upside potential as well. So I think you can see both sides of that.
Yeah, I agree with Henrik as well. It's going to stay. But for Bitcoin, the volatility, as Michael Soy said, will come down when this asset gets more mature. But I think looking at the altcoin, it's definitely going to stay for a while. How we manage it is whether we do much more intense risk management compared to traditional asset. We go through the fund risk exposures to reduce exposures when volatility is great. So take for instance in last March, right? We try to reduce our positions when volatility is picking up in one day, and that's so when we have that measurement, then it's easier for you to risk manage your portfolio. And I think try to put on some hedges as well. We always have some hedges, either we unwind them or we always have some hedges on just in case we need to increase it. So overall the portfolio is not or naked, right? So then we have some hedges on.
Yeah, I don't think volatility is going to leave this space anytime soon. I mean, the reality is we're dealing with super high growth tech, and it's got liquidity probably much earlier than traditional tech. So you get to see a volatile early stage tech market that we've never seen before, because traditionally technology this young wouldn't list until a much more mature stage. I guess the way we've dealt with it with a firm is to launch our DAF Greeks fund, which can profit from volatility and provides a much more stable return outlook. But to be upfront, our other two funds are unashamedly long investors looking to ride the adoption of this space. So far, it's been a great journey on the upside, but it comes with volatility. That's effectively the cost of the substantial outsized returns you can generate from this asset class. And the other thing I would note is over the last 6 months has been somewhat an oddity, and it's been a welcome one. But if you look over the history of this asset class, the returns are made in relatively concentrated periods. So we also think there's substantial risk in being out of the market or trying to manage that volatility if you're looking for long type returns and you're happy to take that potential downside in managing that volatility too much, because you can be out of this market for only a few days and have a substantially different return profile than if you'd stayed long through that period. I think the orders of magnitude of a Bitcoin's life is something like over 10,000% difference if you're out of the market for like the 2 best days of each year. So it can have a concertine significant impact if you try and manage that volatility too much, if you're actually here for the asymmetric upside that we think exists.
Great, and thanks to the audience for sending these questions. We'll probably have one more question and then go to a couple of audience questions. And I guess this question could tie in with some of the questions that we're seeing, and that's from your seat. In this form of an investment, technology or operational side, what is the most exciting thing that you think is going to come into the space over the next 12 to 24 months?
For us, it's just to see the technology used. We've gone through a substantial, what I'd say is Bitcoin's been around for 10 years, but a substantial push over the last 5 years of different use cases being hypothesized, different platforms being built, different applications being built. And we're kind of at that exciting stage where the rubber hits the road and we find out which of these use cases can attract users, and more importantly, which one of them can start attracting revenue and returns for their investors. And so we really are seeing that transition to a bona fide asset class where we've got a fundamental base we can build valuations from and make investment theses from. And I think that's a super exciting thing to be around if you put the sort of adoption curve we're seeing. I mean, from our perspective, this is still the cheapest technology in the world. We're investing in platforms that are doing 100, 200, 300% type growth per month. Like, it's just staggering levels of growth across what's an exciting, vibrant new asset class, traded across new markets and structured through a new asset with a completely new way of doing business. I think there's a lot of things to get excited about, Matt.
Yeah, I think for us is if you look at Asia, right? Recently, there's a big, public listed company that mirror what Tesla or MicroStrategy has done. That they announced that they will be buying Bitcoin and ETH. I think we have been in chat with a lot of listed company in Hong Kong as well, and they are also very interested in coming into this space. I think once these listed company, public listed company, start to look into this asset class, and Asia will definitely come into rise. I think, looking at the stats, Asia crypto holders still, far behind from US and the rest of the world. So I think that will definitely come into play for the next 12 months.
Yeah, there's so much to be excited about in the space for 2021. This might be a year where we see a Bitcoin ETF, for example, in the States and elsewhere. We at OSL Capital, we have focused a lot on DeFi before DeFi was a thing. And I think 2021 will be the year where we'll see scaling solutions coming to Ethereum and to DeFi. And that will bring this tech to so many more people. So that's super exciting in our opinion.
That ties in nicely actually to one of the audience questions. They're looking to hear a bit more about DeFi and potential projects that the DeFi space that you're looking at. And as much as you can, if you can give some color on DeFi and if that is forming part of your portfolios.
Yeah, yes,
DeFi,
for sure.
Yeah, you can go ahead.
Richard, do you want to go?
Yeah, so DeFi is by far the biggest part of our allocation, both across our venture fund and our liquid long-only fund. Like Henrik, we've been investing in the space for a number of years. It was the first use case we identified where tangible returns would be and tangible revenues would accrue to the technology. So it's been where we've been focused. And unashamedly, I mean, that's our background. My team has similar background to me across traditional finance and banking. So we think we understand, I guess the deficiencies in that space and what can be disrupted first and what can actually deliver value for users. So we've invested both, a lot of the liquid assets that have come to market, things like Carver, Uniswap, over that period, and things like Luna, Terra Luna out of Korea. So we've got quite a diverse portfolio of DeFi assets. I think where we get super excited now is we're seeing users and revenue accrue to those assets. So if you look at Uniswap, for example, I think it's annualizing revenue around about $350 million US per annum. On most run rates now, which is just phenomenal for a company that was basically only started back a little over 2 years ago, or a project that was started only 2 years ago. You put another lens over the top of that, and we're sort of seeing that next leg of growth in DeFi. We're starting to see traditional financial players come into the technology and look at DeFi as effectively a funding or a transaction engine tool. So as today, DeFi has largely been solving or providing solutions to crypto native people that either want to trade assets or borrow, those sorts of things. We're really seeing that next evolutionary step, which we expect over the next 12 months, as traditional lenders and other service providers in financial services start to use DeFi as a back end for their business. And that's clearly a universal change in terms of the scope of user base, the scope of capital, and the next leg up, I think, in growth that we'll see across these platforms, even as we start to penetrate outside of what I'd say is the native crypto user landscape.
Yeah, that's right. I very much agree with Richard. We focus a lot on DeFi as well at Apollo. And it could really be a paradigm shift potentially for financial infrastructure, which is super exciting, right? So we divide the space in 4 categories that we diversify in between. So those are lending, borrowing, synthetic assets and derivatives, DEXs, and infrastructure products. So that's how we look at the space. I'd like to add as well that I think it's been definitely an edge for us to be based in Australia. We've seen a really big ecosystem being built down here, not just synthetics, which is very well known on a global scale, but we've seen a bunch of other projects as well coming out of Australia recently, which we have supported some of them.
Yeah, Fundtrade, Polkadot, Chainlink, Compound, and those DeFi projects as well. But I think one thing that people will look into, as I think Richard mentioned, right? I think DeFi right now is mainly used by the crypto world. There's no really a bridge with traditional asset. I think what we want to look into is whether there will be STO that is linked to DeFi. The STO market not yet, fly off. If that is possible, then we can actually have traditional assets into this DeFi ecosystem instead of just crypto asset at the moment, right? So hopefully we see more of that in the coming futures as well.
Brilliant. That's absolutely fascinating. It's clear that we could do a whole 35 minutes on DeFi and the opportunities in that space. So we're going to take a break now. We're going to have the virtual lunch, but I also want to remind everyone that we have a very strong session after lunch. We have some of the big names from the financial services, have DBS, Standard Chartered, Simmons & Simmons, and PwC. So 4 of the biggest names that are now working with crypto, and another panel which we're going to find very engaging. So just to sign it off, just want to say thanks, Richard. Thanks, Henrik and Marco, on a really fascinating conversation. Appreciate your time.
Thank you, Matt.
Thanks, Matt.
Thank you.